Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Tavi Costa, Portfolio Manager at Crescat Capital. Tavi, it's great to see you again.
Hey guys, thanks for having me again.
So Tavi, we had our huge run up in silver and gold and a lot of other commodities, and then they sold off big time. This was like the max panic. Let's call this max panic couple of days from the commodity markets, and we've come back. But now we seem to, I don't know, they're finding a bottom. What are you taking away from the silver and gold markets right now? How are you viewing this situation?
Well, I think there was a lot of people referring to this initial rally that was mostly driven by geopolitics, and I think it was. And this thesis that geopolitics in general doesn't lead to a bull market in gold, a sustainable bull market in gold. I think is off. I think the beginning of it certainly was a panic, a risk-off move to all-time highs on gold levels. Silver still 50+% off its prior highs. But I think we're now seeing this unfolding of the tensions between Russia and Ukraine and some other parts of the world, including China. It only leads to further protectionist policies across the globe. And I think this is extremely inflationary. We're intensified the deglobalization trends we started back in 2015, 2016. I think this is just the beginning. And I think gold and silver ratio is very close to a breakdown. I think silver is going to lead the way to the upside, and it's a great time to be allocating capital. It's commodities had a dip, and then what an opportunity to be buying at cheaper levels. I think we're nowhere done here.
Here's your latest commodities to equity ratio. This tells you we're still in the very early stages for a commodity. If there is going to be a commodity bull market, it's not even close to being over yet, right?
No, I don't think so. I think it's the very first time we're kind of dealing with three macro imbalances all at once. This is the very first time we've seen this in 120 years of U.S. history, at least that I can track data for. And I'm referring to the debt imbalances, the valuation imbalances, and the inflation. We have the debt to GDP problem of the 1940s. We have the inflation of the 1970s, and we have the speculative environment of the late 90s. And those are all real political constraints. They become political constraints when it comes to fiscal monetary policy. I mean, how much can the Fed really raise interest rates? And so I think this is an issue. How do you keep a lid on inflation without allowing cost of capital to rise when you have valuations at these levels at the same time as the debt problem? And so I think we'll continue to see this need of capital allocators looking for inflation hedges, and I think what we're going to see is a rotation out of financial assets and into real assets like commodities. And so I think this is just the beginning. And for people that saw the pullback recently, ask yourself, I mean, is this the beginning or the end of a move? And when you look at the long-term charts, like this chart that you're showing, it's pretty clear to me that we're just at the beginning.
Yeah, so this one jumped out at me recently that you posted. The Hong Kong, this is a 30-year chart of Hong Kong stocks breaking down. What's your take on this?
Well, I think what's happening in Taiwan, China, and Hong Kong is very serious. We've had the escalation of political tensions in Ukraine and Russia certainly brought up this idea that Taiwan is also going to get in trouble here. Mm-hmm. And Hong Kong has been part of that discussion as well. And so we've had a lot of issues, reconciling the macro imbalances in China, especially regarding, their low international reserves relative to how much they have in the banking system, their credit imbalances, the overwhelming amount of debt. And so I think those are all, it's a commodity importer in a commodity rising environment where I think it's going to be incredibly challenging for a country like China to continue to lead the way and print, inflated 10, 15% nominal GDP growth numbers on an annual terms. And so Hong Kong is linked to that, is linked to this migration of folks coming out of Hong Kong, financial services and so forth, and businesses leaving Hong Kong. So it's all linked to the same thesis, which is this reconciliation of all the macro imbalances in China and Hong Kong as well. And that leads to geopolitical tensions too. So it all feeds on itself. And so I'm quite worried about that. This is not I think the recession probability in China increased drastically, and so for the global economy.
Yeah. This is something that I get into a lot of debates with on Twitter with some other types of people. Money velocity versus inflation. And a lot of these guys on Twitter, they'll tell you, oh, there can't be real inflation. There's no velocity of money, the red line, right? Velocity of money is low. But doesn't, this blows that up. This sort of, it's like, why? This is like, well, I'll just drop this chart now on Twitter and just walk away, right? Mic drop.
I love this chart because I think the so-called folks that really understand the monetary system really got this one very, very wrong. And I think inflation, and it's a lesson for you should never rely on one macro indicator to have your view regarding any macro forces out there. And I think inflation is a very complex subject. I think, in my view, we have really 4 pillars of inflation right now. One of them, and I said before, was the wages and salaries growth. I think this is a secular trend, the cost of living rising, what we've had in the Spanish flu, when 1 out of 5 people in the US labor force are engaged in a strike. And now we have government policies trying to drive wages and salaries. The second one is the cost push type of inflation, which is related to the shortages of supply and also the historic trend of investments in natural resources. And the third one is the monetary debasement that we're seeing when it comes to the reckless amount of fiscal spending and what the Fed has been doing. And the fourth one is the geopolitical tension, which also increases the deglobalization trends. Those are all inflationary, regardless of where money velocity is headed. And so I think that those are much more relevant than looking at one factor. And that's the proof right there in one chart.
So I saw this other one you were talking with, or Willem was quote tweeting you. Gold versus the junior miners. What do you take away from this? Are the junior miners have underperformed and have a lot of catch up to do, or what?
I think that goes back to your first question where you asked, about the gold and silver market. We've had this kind of panic-driven rally, which gold was the one leading the pack here. And I think that the next wave is going to be on the parts of the market. Not saying that gold won't go up as well, but I think we're going to get to healthier levels in gold, but led by GDXJ or the juniors or even the senior relative to the precious, even silver relative to gold. And the funny thing about GDXJ is when you look at that relative to GDX, in other words, juniors versus seniors, we're one of the lowest ratios in history, meaning the juniors have really underperformed the seniors, especially more recently. And I think that's about to change. I mean, we saw that back in 2015, back in 2020 as well, all bottoms for precious metals companies. And I think this is signaling the same idea. It's just a question of asymmetry, and so an opportunity in this case. And so I think as we see money flowing into this industry, it's a matter of time until we see that coming into the junior market as well.
You had a really good question on another one of these. This is like this whole episode is like, let's talk about Tavi's Twitter account, but whatever. This is a really good question. How is the largest commodity importer in the world, with all this commodity inflation, still reporting less than 1% growth, 1% growth in inflation? Is this sort of telling you China's numbers are bull? Oh, look, I even responded to this one. I forgot I responded. It was a couple of days ago. Is this telling us China's numbers are bullshit, or what's this telling us?
Yeah, I think it is. I think that's precisely what's telling us. I mean, this whole idea of the lockdowns and of the pandemic in China right now, the PBOC, or the Chinese Central Bank, seems to be the first one to realize that lockdowns are perhaps a tool in order to tighten monetary conditions. And maybe other central banks will apply the same idea soon, but it seems to be the case here. In order to drive commodity prices lower, this is the first time China is really facing not the inflationary problem, but the deceleration of growth and having zero really handle on what's happening with the commodity markets. And so it's just a big problem for China. Not a lot of people are, I think, really interpreting that in that manner. So I'm quite worried about commodity importers. And I think China is a big one that will be facing some issues here.
So Tavi, thank you very much for joining us. We really appreciate you giving us an update on your view. We love your charts. We love hearing from you. You're famous on Twitter and LinkedIn for your data. Everyone seems to be hitting the like button on everything that you put up because it's so good. Thanks for joining us. We really appreciate it.
It was my pleasure being here. Thanks for having me.